Let's get started with your stocks and we'll answer some of the queries sent in by our viewers. Our two experts this afternoon, we have Fani Shekhar of Angel Broking, who's going to answer all the stock-specific queries, and Nikhil Kothari of Erica Wealth Management will be answering all the personal finance queries. Gentlemen, good afternoon. Thanks much for speaking with us. The first query is actually someone who might be a bit worried. Pragya Kothari calls in from Bangalore with a question on TCS. Hi, Pragya.
Hi.
Hi, what's your question?
I actually wanted to know, I've purchased around 10 shares of TCS at the rate of 2450.
Okay.
So I want to know what should I do with the shares since I'm incurring losses in that.
Okay, you bought this a while ago, a few months ago?
Around 3 months ago.
Okay, Fani, what's your take? She's bought it at 2450. Should an investor in TCS be worried at this point in time, or do you think perhaps that this dip could be used as an opportunity to average?
Well, you can average it as long as you intend to hold on to it for a longer term. I expect the stock to dip another 5 to 7% at least before stabilizing, because now the investor preference is shifting more towards Infosys as compared to TCS. But I guess the highlight for the recent decline in TCS has to be the company's admission, or at least apprehension, that they will not be able to make up for the tepid first half of this year, because the street was expecting that they will make it up in the second half. But it seems that due to seasonally poor quarter and more importantly adverse cross-currency headwinds, they will be unable to make up for the revenue expectation that the market had. So I think now the market is now working with a revised expectation of around 14 to 15%, and that's not bad in absolute terms. Only thing that goes against the investor is that she would have bought it at a valuation multiple of around 19 to 20 times FY16, which was the prevailing multiple then. But now I guess the stock has been derated to 18 times and might go down a notch more, while Infosys might go up a notch higher. But from a longer term perspective, it doesn't make a difference. It should be used as an opportunity. Minimum waiting period here is about 12 to 18 months. Expect returns of anywhere between 15 to 18%. Although TCS might not be the most talked about stock because other stocks might give a better return, but 15 to 18% in absolute terms is not a bad return either.
All right, then, that's the view coming in on TCS. In fact, stock has been under pressure. It's currently holding with a cut of around 3%. I think the day's low is 2,365 approximately. So the stock is holding roughly around $11 over that particular level. It was always likely to start off softish, but it's currently not seen any incremental sellings. And also, let's pull up Infosys, because that stock has seen a sharp correction in the last few days. Let's see what that stock's doing at this point in time. Funny reckons maybe that could be another option also. That stock, in fact, is down close to around 0.7%. But let's go to our next caller. Smita Sawant calls us from Pune. She has some investments in Tata Motors DVR. Hi, Smita.
Hello. Yeah, I'm holding Tata Motors DVR 100 shares.
Okay.
At the purchase rate is 380.
Oh, okay.
And I have another script of oil.
All right.
50 shares at 680.
Oil India, that is?
660. Sorry, 660.
Smita, that's Oil India, right?
Yeah.
You've got 50 shares at?
At 660.
660. Oh no. All right, and that one as well has seen a sharp correction.
Yeah.
Okay, Smita, let's try to help you out on this one. Don't lose heart. We've seen a bit of a correction in the last few days, and maybe around 6 to 7 trading sessions. Everything has been falling, but let's see how we can help you out. Funny, couple of stocks she's got. Tata Motors DVR, unfortunately, she's picked it at the top. And Oil India, because of the subsidy, the clarity we're waiting on that subsidy. In fact, that one as well is down close to around $130 from her buy price. What should she do on both these two calls?
So Oil India first. Yes, its subsidy price is hurting, subsidy clarity is hurting both ONGC and Oil India. More importantly, the value of investments has really been marked down by the market, and justifiably so. Because of a declining crude price. Crude price above $80 was good for the upstream, because if subsidy were to wind down and crude were to still maintain around $80, they would have logged a net gain or a significant gain in their realizations. But with crude price also tumbling very sharply to 65, and even if subsidy goes out of the picture, even assuming, that subsidy to a large extent goes out of the picture, I don't think large or even a reasonable gain on the net realization. So you put everything together plus the prospect of a government divestment in ONGC or a special dividend out of Oil India, I think the picture doesn't look very good from a short-term perspective, but since she has bought it, she can hold on, and if the stock declines another 5 to 7%, she can add a little bit more clearly from a long-term perspective. As far as Tata Motors DVR is concerned, again, good buy, especially compared to Tata Motors share, because I don't see, at least for the foreseeable future, any premium that an ordinary share should enjoy over DVR when it comes to Tata Motors, since those kind of corporate decisions are unlikely to be required to be taken. The JLR business continues to be reasonably strong, factoring in a small decline or a small degrowth or a slowdown in China. Other than that, I think emerging markets and new models of JLR especially are expected to do well. Valuations are the strongest point of Tata Motors, very attractively trading. Add to that prospect of India recovery in another 9 to 12 months. I think it's a good buy. She can hold on to actually both.
All right, that's the advice on Oil India as well as Tata Motors DVR. Up next, Sharmila Das has written to us from Ranchi. She says she has investments in Reliance Regular Savings Fund Growth Option as well as the Reliance Diversified Mutual Fund for the last 5 years. She wants to know if she should remain invested in these funds or if she should switch over to something that's performing better. Nikhil, what's your advice?
Yeah, hi. See, Reliance Regular Saving Fund is a multi-cap fund. So this fund invests around 45% to 50% in large-cap stocks and another 50 to 55% in mid-cap stocks. So this fund has been a little bit laggard, but over a long period of time, this fund is good, and she can continue hold on this fund if she has a long-term view. On the Reliance Diversified Power Sector Fund, the fund is a thematic fund, and this fund invests only in power sector related companies, and the power sector has been one of the worst performing sector in last 5 years. The BSE Power Sector Index has given negative 8% CAGR return, and the fund has given negative 1% CAGR return. So what we all normally advise is that for any core part of your portfolio, you should always have a diversified equity fund and not a thematic fund. So for her, what we advise is that she can switch Reliance Diversified Power Sector Fund to, if she want large cap exposure, to Reliance Top 200 Fund, or if you want multi-cap exposure, she can move to Reliance Equity Opportunities Fund, because power is not completely out of the woods and the fund carries huge amount of thematic risk.
Avinash Pandey calls us from Lucknow. He has some investments in ICICI Bank. Hi Avinash.
Yes sir.
Yes, how can we help you?
सर मेरे पास ICICI बैंक के 50 शेयर हैं at the rate 149.40 के हिसाब से.
All right.
और 2 साल का मेरा नजरिया है सर.
All right. और
तो मैं इसमें होल्ड करूं या मैं सेल करूं?
All right, Avinash, let's try to help you with this one. Funny, as an investor, he's bought it at roughly around $150. He's making around 10,000 as we speak. He has 2 years is what his time horizon is. What should he do?
Of course, hold on. See, being the second largest bank and with the economy not really spectacularly improving and all of us betting on how soon it will improve, but maybe over 2 years it will certainly be better than what it is today. ICICI Bank certainly will stand to gain a lot. More importantly, they have been overcapitalized in the past, and to that extent they have been slowly and steadily improving their profitability ratios, whether it is return on assets or return on equity. The slowdown of the last 3 years came at a very wrong time for them when they were just trying to up their profitability. But over the next 2 years, as the profitability inches up, add to that FDI and insurance giving a definitive benchmark to the insurance valuation, insurance subsidiary valuation. I think over the next 2 years the investor can again look to make 50% returns from even these levels. So it's a very good idea for the investor to hold on and maybe on declines buy more.
Alright, that's the advice. अविनाश जी, आपके लिए यही राय है कि अगर ये स्टॉक में आप थोड़ी सी वीकनेस या गिरावट दिखते हैं तो आप उसमें थोड़ा और खरीदारी भी कर सकते हैं और इस स्टॉक में आपको बने रहना चाहिए. Up next, we have a query sent to us by Chandresh Yadav. He writes to us from Pune. He says he's 35 years old and earns about 6 lakhs an annum. He has a home loan already of about 15 lakhs and wants to start his retirement planning now. And he'd also like a little bit of advice on how to save money for his daughter's education. So, Nikhil, he has two clear goals in mind. One is his retirement planning and one is for his daughter's education. He hasn't highlighted the time period that he's looking at, but given the fact that he's 35, I mean, you can do basic math.
Today, children's education planning and retirement planning are the most crucial goals. First, I'll talk about children's education planning. Now, he can plan in two ways. If he's planning to fund the schooling expenses, which may be 3 years or 4 years down the line, and which he wants to fund from a investment which will take care of every year expenses, then he can look at doing a monthly investment in a balance fund. Balance fund invests around 65% in equities and rest in debt. And so which will on an average should give him post-tax 12% return, so which can every year he can withdraw from that fund, which can take care of all his schooling expenses, daughter's schooling expenses. Or if he's planning in a different way, that he only wants to plan for higher education, which is graduation, post-graduation, so which may be 10 years or 12 years down the line, then he can look at investing in a pure diversified equity fund, so that the fund invests 100% in equities, and equity is an asset class which should be able to beat education inflation in the long term. So for balance fund, he can look at, say, SDFC balance fund or ICICI Prudential balance fund, and for equity fund, he can look at ICICI dynamic fund or Mirae Asset India opportunity fund. For his retirement planning, since he's a businessman, he is not contributing to EPF. So how he can plan is that he can do his asset allocation in debt and equity. For the debt component, he can look at doing a regular investment in PPF, and PPF will give him tax benefit and also give him 8.5% tax-free return. For the equity component, because equity is the only asset class we should be able to beat inflation in the long term, so he should have around 75% of his investment in equities. And for equities, he can look at doing a monthly SIP, one in a large cap fund and one in a mid cap fund, because he is around 30 years or 25 to 30 years time frame, so he can look at doing SIP in large cap fund and mid cap fund. For large cap fund, he can look at Birla Frontline Equity Fund, and for mid cap, he can look at IDFC Premier Equity Fund. And regular investment will give him, the equity investment will give him growth and good portfolio when he retires, and the PPF will act as a stable to the overall portfolio.
All right, Rahul Sharma calls us from New Delhi. He has some investments in Havells. Hi, Rahul.
Sir, my friend. Hello, good afternoon, sir.
Good afternoon.
Sir, my पास Havells के 20 शेयर है.
Okay.
At the rate of 300.
Oh.
And Sharon के हैं 250 शेयर at the rate of 52 rupees.
Sharon Biotech?
Sharon Bio.
Okay.
तो सर मेरे को इन दोनों पे कॉल करने थी कि करेक्शन बहुत आ रहा है इसमें.
Sharon Bio का ट्रेड डिटेल्स क्या है? क्वांटिटी और प्राइस?
सर 52 में लिए हैं 250 शेयर.
250 शेयर. ओके.
तो दोनों में सर करेक्शन आ रहा है, तो ये मुझे पूछना था कि होल्ड करूं या लॉन्ग टर्म के लिए इसका भी रखूं.
Right. Funny, he's an investor. He's making a loss on Havells because he's bought it at around $300, and that stock has been under a lot of pressure. And the other stock he's got is Sharon Bio. Do you track that? Could you give him a view on it? He's bought 250 shares at $52.
I don't track Sharon, but Havells I do. And here there are three principal issues. One is the weak consumer sentiment that is leading to very muted consumer demand, something that has led the management to revise its guidance downwards. Two is the sudden drop in European yields that has led to increased pension liabilities for Sylvania that will have an impact on the profitability. And third is the currency volatility that they are seeing in markets such as Mexico, Brazil and Colombia, and that again will have its impact on its margins. So if you combine all these three, you have a domestic top line weakening followed by a volatile margin profile, and due to increased pension liabilities on the books, a lower profitability. So all in all, expect very subdued numbers for this financial year and maybe for the next financial year as well. Generally, you can take off 8 to 10% for each year. I think the stock with a 25% correction is factoring in a lot of it, but don't expect any dramatic improvement considering that near-term weakness persists there. So from a long-term perspective, the investor can hold on, but the wait can actually be longer since the valuations are also at a pretty high premium at around 26 times.
That's true, actually. You know, in the last 1 week odd, this stock has raised about 4,600 crore rupees in terms of their market cap after they released that perhaps the second half of the year could see demand which could be very, very subdued. In fact, a host of consumer durable companies came out and said that perhaps there could be some slackening in demand. But Funny, thanks very much for joining in this afternoon to advise our viewers. Any disclosures?
I don't have any personal positions, neither do we own any of them in the PMS, but our clients may have interest in some or all of them.
All right, thanks, Funny. Thanks a lot for joining in.